$40 billion usually sounds like an abstract number, a boardroom number, the kind that lives in spreadsheets and PowerPoint decks. But this one was supposed to live somewhere much stranger, between the gas pump, the coffee machine, and the refrigerated sandwich case. What began in 2024 as roughly a $38.5 billion bid by Circle K owner Alimentation Couche-Tard for 7&I, the parent of 7-Eleven, quickly grew into a proposal worth about $46 billion to $47 billion. And for nearly a year, it looked like the convenience store business was about to get one gigantic new king. Then, on July 16, 2025, the whole thing blew apart. On one side sat 7&I, the company behind 7-Eleven, a retail machine with more than 80,000 outlets worldwide and an estimated 63 million customers a day. Its North American arm alone operates and franchises about 13,000 stores in the US and Canada. On the other side sat Couche-Tard, the Canadian owner of Circle K, a company with nearly 17,000 stores across more than 30 countries and territories. Sarcastic. In other words, this was not a corner store romance. This was a planetary-scale fight over who gets to sell the late-night soda, the breakfast burrito, the fuel, the nicotine pouch, the lottery ticket, and increasingly, the last-minute dinner. And the logic behind the deal was brutally simple: scale. Couche-Tard said a combination would create a global convenience champion with more than 100,000 locations. The company argued that the real prize was not just store count, but operating muscle, shared best practices, bigger innovation budgets, stronger franchising, and what it called a scaled global supply chain. It even pointed to 7-Eleven Japan as a world-leading operation whose food and replenishment model could teach the rest of the network new tricks. Translation: buy in bigger volume, move goods faster, learn from the best market, and squeeze more profit out of every coffee cup and rice ball. That is why this deal mattered far beyond convenience stores. The modern convenience chain is no longer just a rack of chips next to a sticky soda fountain. These companies increasingly describe themselves as convenience and mobility businesses, and 7&I pitched its North American 7-Eleven arm as the market leader in North America, with strong brand recognition and a top-tier digital offering. So this merger pitch was really a bet that the future of retail belongs to dense networks of small stores that double as food service counters, fuel stations, logistics nodes, and data engines. Tiny boxes, huge leverage. But then came the part of the story that kills a lot of mega deals: math with regulators. Reuters reported that 7-Eleven held about 14.5% of the U.S. convenience store market in 2023, while Couche-Tard's banners held about 4.6%. Put together, that is almost a fifth of the market. 7&I argued the U.S. antitrust challenge was the threshold issue from the beginning, and by March 2025, the two sides were discussing a possible divestiture package involving more than 2,000 overlapping stores. 2,000. That is not a tidy little fix. That is practically building a whole new rival out of the spare parts. And there was history here. Bad history, if the goal was to calm Washington down. In 2021, after 7-Eleven completed its $21 billion acquisition of Speedway, the Federal Trade Commission said the deal harmed competition and required divestitures in 293 local markets across 20 states. That earlier fight mattered because it gave critics a ready-made argument. If 7-Eleven already had to unload hundreds of stores to get the Speedway deal through, what exactly would happen if it tried to combine with Circle K too? 7&I's own language reflected that fear, calling the potential remedy package unprecedented in scope and size. So 7&I did what takeover targets do when they want to say no without looking asleep at the wheel. It unveiled its own dramatic rewrite. In March 2025, the company named Stephen Dacus as CEO announced the sale of its Superstore business group to Bain Capital for about $5.37 billion. committed to roughly 2 trillion yen in share buybacks, and said it would pursue an IPO of its North American 7-Eleven business by the second half of 2026. The message was crystal clear. We do not need to be bought to unlock value. We can slim down, focus on convenience, sell the slower assets, and let Wall Street reprice the crown jewel on its own. Couche-Tard insisted the deal was friendly, financed, and fixable. It said it had support from financing banks, offered a large reverse termination fee, and claimed there was a clear path through U.S. regulation. It also publicly promised that its intention was growth, not store closures or job cuts in Japan. But by mid-July 2025, the Canadian company said Seven & I had engaged in a calculated campaign of obfuscation and delay, and it walked away. Just like that, the biggest foreign takeover Japan had ever seen on paper became another monument to how hard it is to merge giants when politics, national pride, and antitrust all start shopping in the same aisle. The twist is that even in failure, this deal explains where retail is headed. The next retail war is not just about who has more stores. It is about who controls the fastest supply chain, the strongest food offer, the smartest loyalty app, the best real estate corners, and the data trail of millions of daily micro-purchases. Seven & I is still pushing its convenience-first transformation, and its stated plan remains a North American 7-Eleven IPO by the second half of 2026. So the merger died, but the strategy did not. The shelves may look ordinary. The battle behind them is anything but. Like, comment, and subscribe to stay informed.